Hello, and welcome back. So, here is the question. How do we value a stock? Like, what are the ways to actually do that? How do we know how much a stock is worth? And in this video, I'm gonna take you through the whole foundation of how we're valuing something. And this is about pretty much every investment, not just stocks. This could be applied to anything. And this is why we are going to start off by talking about something different, not really stocks, but we will actually cover and understand how we should be valuing a stock and an investment for that same matter. Now, when we're investing in something, the only thing that we want to be making out of it is money. And so this is what it comes down to. Of course, there are a lot of variables playing along that. I mean, there's like growth, for example. There's like how much debt a company would have, for instance. There are a lot of variables there. But on the very core of that, it comes down to one thing: how much cash flow we're going to be making, how much money. Otherwise, why would we spend our money? We only spend our money to make money. And so the question is, how much should we be spending, for example, to buy Apple? Now, to understand that, let's start with something very, very simple now. And I have created a tool here in our pretty much investment tool, in which I'm talking about interest. This actually is an compound interest calculator, as you'll see. So what does this do? Let's just say that we are starting with $1,000 today. We're willing to invest $1,000, and we are not really willing to make any monthly contributions to that amount. And we're going to be investing this money for, let's just say, 20 years. And that's going to be in the S&P 500 index, which typically makes about 10% a year. That's the average. And so we're making 10% as an interest rate on this one. Now, if we hit calculate for the next 20 years, you're going to get a full breakdown here of how our money gets increased, compounded over the years. And eventually we're sitting at $6,700 about when year 20 comes. So that doesn't sound like a lot, but remember that this is like about 6 times as much as we started with, without making any contributions. Now, things change a lot when we're adding some money on top of that, and this is why it's a good idea to keep adding money to your investment portfolio. If you add $200 a month over here, which is pretty much $2,500 a year on top of what you have already contributed, then if you hit calculate, you will see that now you're making way more. You're making $144,000 in the next 20 years, so this matters a lot. Now, okay, we understand that compound interest is very, very important. This 10% transforms our money to way, way more. We started with $1,000, and now we have way, way more than that just by contributing $200 a month. We get to 144 just because of compound interest through the years. And of course, if we're looking at let's just say a retirement account, which could be sitting for 50 years, for example, then we are getting almost a $3 million account here, which is absolutely insane. Again, compound interest is all about the years that you are compounding values compounding money at. Now, there is a very, very important question that we are attempting to answer with our discount calculator, and this is about how much an investment is worth. So let's just say I'm willing to sell you an investment that makes $10 a year. So you do know that the investment makes $10 a year, but every year it looks like we are getting, let's just say, 10% growth. So it's not actually $10. Let's just not go $10 a year. Actually, let's start with that. Let's just say that annual growth is 0 here. And discount rate, I'm going to explain later what it is. But let's just say that we have an investment that we know that it's going to be making $10 a year. So basically on year 0, we start with $10, and then every year we're getting $10 over here. Now, if you actually had this investment growing by 0%, then at the end of the year 10, you would have made $100, as you can understand. That makes total sense, right? I mean, we are not making any extra a year. It's just $10 flat. Now, let's just say that our investment, as with a company, grows its net income, you could think about it like this, by, let's just say, 10%. So now we're having annual growth of 10% in this case. And you will see that, of course, year 1, we're going to be having $11. That's 10%, and that's 10% of this one, so 12.10. And then we're arriving at 25.94. And overall, we have made $175.3 total in year 10. That's every year added together over here. Now, This is fine, and you can say that okay, after 10 years with this annual growth, I'm making $175. So it makes sense to pay less than this value because this is what I'm gonna be making, right? So I need to be paying less. But is it okay to be paying, let's just say, $100 or $120? It sounds good at first sight, but it's not really good because we haven't calculated for any profit that we want to be making in between, and also we haven't calculated for inflation, which is another thing that's eating up our money. So for example, $10 today are not the same as $10 in year 10 because there has been inflation in between. Every year your money has been cut down, let's say by 3%, 4%, 7%, which is currently 8%, for example, this year. So all of these years your money gets deducted because of inflation, and again, you haven't calculated for your gains. This 175 is what you already know about, is what the company, the business that you're buying, the investment is already generating. So if you pay 175 for it, you're not making anything already. So you need to be accounting for that as well. And this is when discount rate comes into play. So discount rate actually tries to calculate how much we're going to be making a year and actually discount this amount so that it actually reflects this gain. And so you will see future value here, which is the value without any discounts, and you'll see that currently the present value is exactly the same. That's because we haven't discounted that value. Now, let's just say that including inflation, we want to be making 15% a year on our money. That's a return on investment. And so if we add 15% here and we hit calculate, you will see that the present value of money has changed here. Why? Because it has adapted to the discount rate. So what are we doing right now? We are saying to the program over here, tell me how much $25.94 is worth 10 years from now when I'm accounting for a 15% gain on my investment every year. How much is this money worth to me today? So practically speaking, this is worth to you today $6.41 if you account for all this discount rate and the annual growth of 10%. And now, if you add these values together, you are way less than what was the total before, which was $175. Now, after discounting for 15%, you are actually, you would be making $78.95, which means, this is exactly what it means. It means that if you pay $78.95 for this exact investment, you're going to be making 15% a year if this investment grows annually by 10%. And so this is the golden price basically to pay. Anything less than that is obviously better. Anything more than that is worse. And of course, if you calculate it for less, let's just say 10%, and you hit calculate here, you will see that now we're sitting at $10. All of these are $10. Why? Because it basically neutralizes itself. We grew 10% and we discount it by 10%. So basically it's back to $10. And if you add those together, we're sitting at $100 right now. And it means that if we pay $100 for this investment today, we're gonna be making pretty much 10% a year. That's annual growth on our money. So we're making 10% on our invested money, that is. Okay, so as you can understand, this is how we calculate the discount, the cash flow that the company generates, and we discount it for the present value of today, because again, in between there is a lot of risk. There's like inflation, and we also want to be making some profit, so we account for that with our discount rate here. And so if we go back to our stock analysis tool here, this is exactly what we are doing with a discounted cash flow model. So in this case, we were looking at Apple here, and Apple has some metrics which actually also we need to be taking into consideration. But if we go to our stock evaluation tool, this actually tells us what Apple has been doing in the previous years. And so fiscal year 2021, they made free cash flow of $92.95 billion. So what we want to be doing is, starting from this free cash flow, we want to be doing the exact same thing that we did with our discount calculator. And this is exactly what this tool does. So we are projecting that the revenue is going to be growing at a specific point. Let's just say 10%, 11%, and 12% here. Which is based on the historic averages, so it makes a total sense. And the margin that the company is going to be generating out of this one is going to be 20, 22, and 24. Now again, this is the whole concept is exactly the same as the discount calculator, but it's more involved because it includes net income, free cash flow, and revenue. And so it gives you a much more precise picture here, because again, we're talking about a company and its economics here. And so if we go, let's just say 100, 105, and 110 here, that's incorrect. And now we get to an annual return of what we did earlier, 15%, which is what we want to be making a year. And we hit calculate. The tool will actually tell us how much we need to be paying today. It's exactly what we did here. If we want to be making 15% on our investment a year. And for the case of Apple, we need to be paying this kind of money for our low estimates, for our medium estimates, and for our high estimates. And this is exactly what we're doing with our model here. We're calculating how much money the stock, the company, will actually bring us back if we pay this amount today. And you can imagine that at its current price of 141, we're actually getting less on our money if we buy the stock today, even for our highest estimates here. And you may be wondering, okay, how do we actually calculate that Apple is having so many investors included? Like, how do we know that this is the correct price? The way we know that is because when we're buying stock, we own a percentage of that stock. And all these calculations are per stock calculations. And how do we actually do that per stock? We get the amount of outstanding shares here. So we do know how much the total is in terms of outstanding shares for Apple. And so we know that we need to be dividing that amount by dividing our gains by that amount. So we get the gains of the company as a total, and then we divide it by the amount of investors, or basically the amount of outstanding shares, pretty much. And so this is how we can intrinsically calculate the value of an investment and how much we should be paying for it today. And of course, as you can understand, you could be using this very handy tool, I feel, for any sort of investment. So if somebody comes up to you and tells you, I'm going to give you an investment that is going to be making, let's just say, $100 to you today, and then every year it's going to be increasing by 15%. You can just go to the tool over here and be like, okay, what did he tell me? $100 a year, and it's growing by 15% a year. Now, how much do I want to be making out of this investment? Okay, I can invest in stocks and make 10%. So in order for me to make sense to buy this one, I want to be making more. I want to be making 14%. So what should I pay this guy? So if you go here, you will see that what you would be making in the end of 10 years over here is a 14% gain, of course, because you have discounted for that. And in order to do that, you need to be paying this guy $1,000.50. Now, if you didn't have this discount, you would have calculated that you are making $2,334. But again, remember, you haven't discounted for your profit and for inflation. And so over here, the tool automatically tells you that in order to make this happen, in order to make 14% on this kind of assumptions that the guy gave you, you need to be paying him $1,000.50. And so if you pay more, you are probably overpaying, is what the tool is telling you here. So hopefully that makes sense. Please let me know if something is unclear here, and I will explain maybe at a later video, but hopefully you enjoyed this one. If you did, please remember to leave a like and subscribe, and of course you can gain access to this tool and everything else that this tool includes over here, which is a lot of stuff, by becoming a Patreon, and you can find a link in the description box below this video. Thank you for watching this one again, guys, and I'll see you soon. Bye bye.